Welcome to ING's Think Aloud, where we try to make sense of the world in the most unbanky way we can. In today's episode,
despite the extraordinary support we've already provided, we face profound economic challenges. In just 2 months, our economy contracted by 25%, the same amount it grew in the previous 18 years.
UK Chancellor Rishi Sunak has laid out the next phase in the government's response to the COVID-19 pandemic, as the economy reopens after a 3-month lockdown and the worst slump in 300 years. He announced new measures to support the job market as the furlough scheme ends in October, cuts to VAT and property taxes, and restaurant vouchers to help sectors that have been hit particularly hard by the crisis. But will the new plans really help to minimise job losses and stimulate demand, as consumers remain wary about the virus and social distancing measures remain in place? I'm Rebecca Byrne, and today I'm joined by James Smith, ING's Developed Markets Economist, to find out. James, the Chancellor announced that the furlough scheme, where the state is paying some or all of workers' salaries, will end in October, but there have been a raft of other measures to support the job market. Are these going to be effective?
Hi, Rebecca. Yeah, well, there's little doubt that preserving jobs is by far and away the biggest priority facing the Chancellor right now. As you say, the flagship job retention scheme will end in October, and between now and then, the contribution to wage bills being made by the state will be gradually reduced from the current 80% subsidy. Now, clearly removing such unprecedented government support in the jobs market is going to bring about some job losses. And despite the majority of sectors now being able to reopen, at least in England, it's clear that social distancing measures will make operating profitably pretty challenging for a range of sectors. I think what the pandemic's also doing is changing habits, where people spend, more home working, for instance, seeing less footfall in the city centres. We're not going out and eating and drinking in our usual places. So that's causing issues as well. So firms will be making changes, but to try and mitigate some of that, the government has said it will pay £1,000 bonus per employee that is brought back from furlough and kept employed until next January. Now, on the face of it, that seems pretty generous. In the accommodation and food sector, for instance, which is probably the heaviest user of the furlough scheme, that would be enough to pay about a month of earnings. And we know anecdotally as well that those staff members that have tended to be furloughed are often at the lowest pay brackets as well. So it will help. Will this change the course of the jobs market, though? I think not entirely. Clearly, if you're a business heavily affected by social distancing, it's probably not going to swing your decision. But for some firms more divided on whether to make job cuts, it might help reduce the scale of the redundancies.
Right. Well, Sunak also announced a VAT cut from 20% to 5% for hospitality and tourism, as well as cuts to stamp duty, and he's offering vouchers to eat out. Will that help to stimulate demand?
Well, I think one of the real challenges is that all the usual things a Chancellor might do in a recession to inject some life back into an economy probably won't be that much use this time around. And I think at the moment, tax cuts largely fall into that category. While there's clearly a lot of depressing news coming out of the jobs market, there is still a large pool of consumers who have been fortunate to keep earning through the pandemic, and with not much to spend the money on, will have seen savings increase involuntarily. Now, that's a pretty unusual thing to happen in a recession. But even so, we're not really seeing the demand spike back up as shops and more recently restaurants, pubs in England have reopened. Now, we'll come back onto that a bit more in a minute, but what that maybe suggests is people are still very wary about the safety aspect of all of this. And that implies that cutting taxes to put more money in people's pockets probably isn't going to suddenly entice people to go out and about and start spending again. Now, the government, as you say, is trying to get around this problem by experimenting a little bit, giving 50% off if you visit a restaurant on certain days of the week in August. Now, other countries have done something similar. Actually, Wuhan in China did something like this a few months ago. And that probably stops the issue of, saving the money if the cash was given to households directly. But does it get around the issue of safety? Probably not. If you're worried about sitting in a restaurant, giving people a fiver off their pizza probably isn't going to change their minds. Now, on stamp duty, so property tax, it's kind of a similar problem, I think. Here, the challenge is less about safety, but more about job insecurity. Unemployment expectations are really spiking, given what we were just discussing a minute ago. And while cutting stamp duty might help at the margin, I don't think it's going to be the central factor in people's decision to buy a new home.
Right. Now, you were talking there about shops reopening. Non-essential shops have reopened. We've started to see pubs, bars, cafes, restaurants open up as well. And we've seen pictures in the media of crowds of people, particularly in central London. So it's very early days, but are there signs that there's been some pent-up demand? Or what does this mean for the shape of the recovery?
Yeah, well, as I kind of hinted at a minute ago, there doesn't seem to have been a huge initial rush. Interestingly, if you look at Open Table, who do bookings for restaurants, they've only seen a very partial recovery in bookings. Polls have also shown that people aren't all that keen to go rushing back to their local pub either. Now, that might change a little bit over coming weeks. As you say, we may see a bit of pent-up demand for other things. Retail sales, for instance, might actually see a decent rebound now the shops are reopen. But I think we've really got to be careful in distinguishing whether this is a self-sustaining recovery or just a post-lockdown spree. Now, our colleague Rob Carnell, in one of his notes a few weeks ago, quite memorably said, buying some trainers for your son to replace the ones that got a hole in during lockdown isn't the same as a recovery to pre-virus demand. And it's quite a good example. I think actually housing is going to be another interesting test case because anecdotally there seems to have been a bit more activity there now the market's reopened. People may be keen to move if they've been stuck sort of mulling it over in their old property for the last few weeks. Also transactions going through that were stuck before the market closed. But I think activity will probably tail off again as the economic story begins to dominate. So I think when we look at that in the context of the overall recovery, yes, we're going to see a fairly sharp rebound in growth in the near term, just by virtue of the fact that stuff is reopening. But it will take a little longer to get back to levels of activity that we were used to seeing before the virus arrived.
Yeah. Well, the Chancellor said in his statement that this is only the second phase in the response to the pandemic. So presumably there will be other measures to soften the blow. What are these likely to be?
Yeah, well, I think when the Chancellor talks about a third phase, really, I think that's when, if there is a vaccine that has been rolled out and therefore means social distancing can go for good. Now, at best, that time probably isn't going to come until next spring and potentially not until much later. So I think for the time being, it's very much going to be a case of tackling the rise in unemployment and helping those dislocated workers into other sectors. So who knows exactly what policy mix we might get over coming months. But if there isn't much better news on the pandemic as we head into next year, then I suspect, what we've heard about this week on wage subsidies and apprenticeships, I don't think this is the last we've heard about those kind of things.
Is there anything the Bank of England can do at this point to support the economy? It's not ruled out negative rates. Is that something you would expect, and would it really help?
Well, the bank's already doing quite a lot. It recently expanded its quantitative easing program again, for example. But there's an interesting debate brewing on the MPC about what might come in future. Now, the new Governor Andrew Bailey said recently that he'd prefer to start unwinding the balance sheet, so reducing the number of government bonds the bank holds before raising rates again. And that's quite a departure from the Carney era where it was very much the other way around. Now, okay, you might think, all right, why are you telling me this when we're still in the midst of a crisis? But the reason is that this may get interpreted by some investors as a sign that the bank's getting a little bit more wary about expanding its balance sheet through QE further if we get another patch of market turbulence. Now, in the event, that's probably not what would happen. Policymakers would act. But in the meantime, that will probably fan the debate over negative rates further, as you say. I think in reality, the jury is still out on whether the bank would actually go down this route. The potential negative effects on bank profitability are obviously pretty well documented. Maybe what they would do first is reduce the interest rate they charge on the kind of loans to banks, which are designed to encourage lending to SMEs. That's probably a more targeted way of doing negative rates in the first instance. But I guess the main message is this crisis, as we were saying a minute ago, long way to run. And that means the pressure on the bank one way or another is going to stay pretty high.
Yeah, well, the OECD has said that the UK economy could be the worst hit among leading nations this year. But it also predicts the strongest growth for the UK in 2021 at 9%. Is that in line with your view?
We're a bit more cautious. We do think it's going to take a good couple of years at least before the lost output is regained. Having said that, we will see what on the face of it looks like a pretty healthy 2021 growth number, perhaps actually slightly bigger in the UK than other countries. But, and this is quite an important but, This is really just really an arithmetic thing. The UK saw probably a sharper and more prolonged decline in second quarter activity than some other developed economies because the lockdown kind of lasted a little bit longer than some other parts of Europe. And that means when you compare the whole of 2021 to the whole of 2020, just mechanically, it means that next year's overall growth will appear pretty decent. So I think it's an important reminder that we should be paying a little less attention over the next year or so to the relative annual growth figures between different countries and really pay more attention to the level of GDP and where that is relative to pre-virus levels.
Right. James, some people thought that given the economic calamity caused by the coronavirus, Britain would extend the Brexit deadline, but they've not done that. Michel Barnier says serious divergences remain. Is there going to be an agreement?
Well, the timeline to agree a deal was already pretty tight before all of this, and it's been squeezed even further by COVID-19. But as you say, the transition period, which is due to last until the end of December this year, won't be extended. So if a deal is going to be done, it realistically needs to happen by October to allow time for the whole thing to be ratified. Now, that's not long, particularly when you bear in mind that these things usually take years, not months. But I think there is scope for an agreement, and that's because it all really boils down to a few key issues. And actually, having more negotiation time probably wouldn't necessarily make that much difference. Now, we're still tempted to say that a deal is narrowly more likely than not. Obviously, talks haven't been going particularly well over the last couple of weeks, but there is still scope for compromise, most notably on fishing and even on state aid, which is by far the most contentious issue here. A number of potential compromises have been proposed over the last few weeks. I think at the end of the day, what we've got to remember is there's a fundamental difference in the way both sides view this particular issue. The UK especially wants greater autonomy over how it helps different sectors recover from COVID-19. And rightly or wrongly, the last few weeks have thrown state aid into greater focus. So compromise will remain a challenge. So I think the bottom line of all of that is, yes, a deal is possible, but the risk of there not being a trade deal is also fairly high, and probably much higher than it was last October when we were talking about the risk of a no-deal Brexit back then.
Well, the coronavirus will probably make it quite difficult to gauge the success or failure of Brexit, but what sort of impact is it likely to have on the economy next year? Would the UK have seen much faster growth without this? How much is it really going to affect GDP?
Well, the effect is going to be significant, and actually for the economy, whether there's a deal or not, the impact's still going to be pretty big, because at the end of the day, even if there's a free trade agreement, the UK is leaving the single market, it's leaving the customs union, and that's where the bulk of new costs are going to come from. Now, the biggest concern is that a large chunk of firms are not going to be fully prepared for these changes. This time last year, when we were talking about this, it was estimated that there were about 240,000 firms who've only ever exported to the EU, so aren't used to all of these new checks and form filling and all the rest of it. So the risk is with what's going on with coronavirus, companies aren't going to have the time and energy to really look into what they need to do ahead of the transition period ending, and won't have the capacity, as I say, to really prepare. So what does that mean at a macro level? Well, I think the jury's still out. There is an argument that the sheer hit to GDP that we've seen from coronavirus, completely unprecedented, will mask the hit when trade terms change at the end of the transition period later this year. That's maybe true. And if we were to, say, get a vaccine on a more optimistic timeline, then perhaps the early GDP hit will be offset by a recovery in other parts of the economy if social distancing begins to be relaxed by, say, in the spring. But it's worth remembering that the sectors most likely to be affected by changes in the way the UK and the EU trade, the likes of manufacturing, for example, they're not necessarily the same as those that have been hit the most by COVID-19, recreation, hospitality. So whatever happens to Q1 GDP next year, I think there's little doubt that the UK is at a greater risk of a slower overall economic recovery. And all of this could add further pressure to that backdrop of rising unemployment. So if we bring it all back to where we started, for Chancellor Rishi Sunak, I think his role in helping the economy is still far from over.
Okay, James Smith, ING's Developed Markets Economist. Thanks very much.
Thank you.
This podcast has been prepared by ING solely for information purposes, irrespective of a particular user's means, financial situation, or investment objective. The information does not constitute investment recommendation, nor is it investment, legal, or tax advice, or an offer or solicitation to purchase or sell any financial instrument. Read more at think.ing.com/content-disclaimer.